Hello, everybody, and welcome to our virtual tax school webinar series. My name is Amar Medic, and I am the product marketing manager for TaxWise. Today's topic will be maximizing Schedule A deductions. We will share some practical examples on how to maximize your client's tax refunds with typical Schedule A deductions using TaxWise Online. Keep in mind that we do try to host these once per month, so if you find today's session to be informative, please be sure to join us in the future. Throughout the webinar, you'll be able to submit your questions to our team and get them answered live. With that said, I'm very pleased to introduce our speaker for today, Mr. Ryan Hubbs. He is a CPA and solutions architect here at Wolters Kluwer. Ryan has years of experience working in the tax industry and will be sharing his insights on how you can maximize Schedule A deductions for your clients. So with that, let's get started. Ryan, please take it away.
All right, thank you very much for the kind introduction, and thank you everybody for taking a little bit of time out of your day in order to join this webinar. And I'm actually very excited about maximizing Schedule A deductions. The reason I'm so excited is this is really, I've hosted, I think, webinars here for all of the schedules now. This is the last one. And this could be applicable to every one of your clients. Not every one of your clients will take the Schedule A, but for the ones that do, they are going to love you because you can really ramp up the deductions and really minimize their taxable burden. So very excited. Thank you so much for joining. And let's go ahead and get started. If you've joined with one of these before, you've probably heard my voice, you know who I am. But if you are new here, just a very brief background on myself. My name is Ryan Hubbs. I have my background in accounting. It's what I went to school for. Once I graduated, moved up to the DC area, worked for 2 CPA firms up there, did a little bit of everything, did some nonprofit work, some business audits, but the vast majority of what I was doing was taxes. That was probably over 80 to 90% of what I did at those firms. I've done thousands of tax returns, and I currently work for Wolters Kluwer. And in my current capacity here, I am a solution architect. Solution architect is just a fancy way of saying I'm a product specialist, and it's really my job to match up prospective clients with the right tax software. And as part of that, I do like to host these webinars just to pass on some of the knowledge that I've gained over my years in this industry. Now, today, I want to first go over broadly what our objectives are going to be and what you can expect out of this presentation. And obviously, we're going to be doing a broad overview of itemized deductions. And then we'll be looking at the strategies that will maximize Schedule A deductions. And when I say maximize, it's a bit of a trick word because, yes, the more you know, the more you'll be able to deduct. But just to give you an anecdote, I think there's a real misconception of how our clients view us. And just last weekend, I had a friend come into town. He came and visited, and I don't know how we got on the topic of taxes, but we did. And he was expressing dissatisfaction that he went to H&R Block and he gave them $600 to do his tax return, and he only got a $900 refund. And what I was trying to explain to him, well, it's not an investment. It's not I'm going to give you $600 and you're going to give me X amount of dollars back. Really, we're using our knowledge to make sure that we are using every deduction possible. But at the end of the day, there's only so much we can do based off the financial data for that prospective client. And I always like to take a little bit of time just to stress that we're having those conversations with our clientele and really setting realistic expectations. I did my best with my friend to try to explain what was going on and why he shouldn't be quite so mad with his tax preparer. I don't think I did a great job. I don't think he understood. But, these conversations can be very important with our customers just so they get a clear understanding of what the scope of our work is. Once we go and look at not only different categories of deductions, some of the limitations that apply, we're going to be looking at something very interesting. When should I force the itemized deduction to the state return? And this is a bit of a niche situation that you may find yourself in. But there are many states that if you take the standard deduction on the federal return, it's going to require you to take the standard deduction on the state return, and vice versa. If you take the itemized on the federal, you need to take the itemized on the state return. And there's going to be certain situations where even if the standard deduction gets you a better refund federally, there may be times where if you itemize, you get a worse refund federally, but such an improved state refund that it's going to offset the balance and it's going to be more beneficial to your client's refund overall. And What's really nice about this is that within TaxWise, you can really find out if this is going to be the best route with just a single click of the mouse. I've gone ahead, I've set up a return to kind of show this up, and we'll be spending a little bit of time on that. And then lastly, we'll be doing identifying differences between above the line and below the line deductions. In my opinion, above the line is a little bit better. And if you do offer financial planning to your customers, I would be focusing on the above the line deductions, and we'll get into the differences and, what deduction is what in these two items and why I believe that most of the time the above the line deductions are going to be better. And we're going to be doing all of this while using a tax preparation software. We're definitely going to spend probably the first part of this presentation going through PowerPoints and learning broad core concepts. But once we get through that list of all the different things that we can itemize, absolutely going to go into a tax prep software, and I'm going to show you exactly where to enter in all of these deductions. So with all this being said, let's start with our first bullet point, and let's do a broad overview of itemized deductions. And if you don't know, this is kind of like Schedule A 101. These are going to be IRS approved categories that can be used to reduce the taxable income. And it should be noted that the IRS is constantly changing what is approved. They're in the process right now. They just eliminated a whole bunch of them. They may add some back in the near future. We'll have to wait and see. And these expenses are going to be reported on the Schedule A of a tax return. And what you really, I guess a common question that I get is, well, can I take a little bit of the standard deduction and then take it itemized where it makes the most sense in order to get the best refund for my clients? The answer to that is going to be no. You cannot mix and match the standard and the itemized. It's really going to be up to you in order to pick which one is best. And as you go through and, depending on your level of experience, maybe this is you're thinking about just jumping into doing tax returns, or maybe you've done a bunch, you'll kind of learn when to itemize and when to take the standard deduction really at a glance when you look at your client's organizers and the different items that they've given to you that they think should be deducted. Once you get good at it, it can be a very, very easy process for you to quickly know which one is which, and I'll give you some tools here to help you with that in just a little bit of time. But before we get into some of the specific items that you can go ahead and deduct on the Schedule A, I do want to open this up to our first polling question. And it's a common question that I get is that, are tax preparations fees allowed to be an itemized deduction? So let's go ahead and open up this first poll. We'll give you all maybe 45 seconds to a minute in order to answer, and then we'll give the explanation to if they are or if they are not able to be deducted. And, if you are new, don't worry if you get it wrong. This is supposed to be a learning experience. We're not going to grade these tests, these questions after the fact. We're not going to share it with anybody. So feel free to just go ahead, answer. It's really my job here to give you all as much knowledge as I possibly can before we go ahead and start off the next tax season here.
All right, I'm going to go ahead and close it.
Absolutely.
And we've got 53% saying yes and 48%. I don't know how those numbers, but yeah, basically it's split. More people saying yes.
Excellent. So pretty much split down the middle. So this was a bit of a trick question, as you used to be able to deduct the tax preparation fees. This has recently changed, and this is an eliminated deduction. And we can see based off this slide, on the left-hand side, we're going to have our allowed deductions. And then we're going to go over just some of the things that have been eliminated. Back when I was preparing tax returns, basically every return I did, I had to put in the tax preparation fee since I was the one doing the taxes, and I'd have to enter in that amount. That is changing moving forward here. And some of the other eliminated items are investment fees, job expenses. Moving expenses really killed me this year. I did 2 cross-country moves for the first time in my life, from Virginia to Texas and Texas down to Florida. Unfortunately, those have been eliminated. I am not going to be able to claim that on my tax return. When it comes to allowed deductions and some of the deductions that we're really going to be going over in detail today, medical expenses, and this is going to be subject to certain qualifications. This is going to be subject to certain limitations. State and local taxes, property taxes, I think, are by far the most common that gets reported. We'll be going over where to go ahead and input that information into a tax preparation software. And then mortgage interest. If you own your house, you're going to get a 1098. On that 1098, which we will look at, it's going to go and show interest income as well as the real estate taxes. You're probably going to be able to deduct both of those for your client, depending on a few limitations. And then lastly, charitable contributions and gifts. Charitable contributions, they can either be cash contributions. You can also, if you go to Goodwill and you donate clothes, for example, that's also going to be a deduction that you can take on the Schedule A. It's going to be deducted at a lower rate than if it's just straight cash, but still going to be able to take it. And then gifts, I would say gifts are most common, not exclusive, but most common, going from a parent to a sibling. And something that I always would tell my clients, best to give gifts while you're still alive. And the reason for that is a lot of people think that when they pass away and their money, transfers down from them to their children, that's not going to be taxed. And we know that is going to be taxed. Better to go ahead and give them the money now, watch them enjoy the gifts that you give them while you're still alive, and go ahead and take that tax right off. Moving forward from this, before we really start getting into standard deductions, or excuse me, itemized deductions, I do want to go over standard deductions. And as the tax law has changed recently in the past, 4 or 5 years, the standard deduction has really started to become the more dominant deduction. You're probably going to use it for the majority of your clients. And the important things to note about this are the deduction is different based off your filing status. We can see single and married filing jointly, doubling up basically. The deduction that you can take had a household always a little bit lower, but these are pegged to increase on a yearly basis and try to match inflation. And we can see what the deductions are going to be next year for 2023. And what I would always do, and what I usually recommend doing, is printing out a chart like this, doesn't have to be this exact one, and putting it somewhere where it's easily accessible. Because once you get your head, once you memorize these numbers, I should say, you're going to be able to look at your client's organizer and see the prescriptions and the doctor's visits and their real estate taxes. And you're probably going to be able to pretty quickly know, okay, do I need to go and actually go and fill out the Schedule A? Or can I see, they had $2,000 in medical expenses, they paid $6,000 in taxes, that's all they've really given me. Well, that's only $8,000 before you even go into any of the limitations that may apply to this. You're going to quickly know the standard deduction is better. So the quicker you can learn this list, if you make it as easily accessible as possible, really going to help you out as far as getting those returns done as quickly as possible. And just one last time, because it is a common question I get, you cannot take a standard and an itemized deduction. You must choose one or the other. So let's go ahead now and talk about medical expenses. And there's, like all things in the tax code, expenses, deductions included, there's always going to be some qualifications that must be met in order for these to be claimed. And, I'd say the broadest qualification is the IRS is going to allow you to deduct unreimbursed, that's a key word here, unreimbursed medical expenses for preventative care, treatment, surgeries, and dental and vision. There's going to be some limitations to what can be deducted based off doctor diagnosis as well as financial limitations. And we'll take a look at this in the software, but your deduction is going to be, you're not going to see any of the deduction from these expenses until these medical expenses get to 7.5% of their total AGI. And keep in mind, unreimbursed medical expenses is really the key word. If you rack up a ton of medical expenses, but you have an insurance company that goes and reimburses you later down the line, those are not going to be tax deductible, since technically you are being reimbursed and you're not really incurring the expenses. And it should be noted, you have to pay for these items. I have a friend who is a hypochondriac, and he probably goes to the hospital 4 to 5 times a year for, various little small knick-knack reasons. And he never actually pays off his medical expenses. He doesn't have insurance, so it's not being reimbursed. He cannot claim those expenses because he has not paid for them. You have to accrue the expense, and then you actually have to pay it before you can go onto your tax return and start claiming that deduction. And then lastly, for tax purposes, it may be best to not put off medical expenses into the next year. And what I mean by that is, due to the 7.5% AGI cap that needs to be hit in order for anything to be deducted, if they're in a situation where maybe they're thinking about doing some preventative care in Q1, January, February, March, you may want to advise them, just go ahead and do it now. Let's go ahead and really ramp up the deduction for this year. So we're going to just have to hit that 7.5% cap the next year. Now, I understand what you're probably saying is, well, what is if they need critical surgery? I'm not saying push that off. But really, when it comes to preventative care, maybe dental and vision, if they can lump these up on a biannual basis where they really rack up the expenses, in a year, and then maybe they put off some of those the next year, really going to help out for tax purposes. Obviously, I'm not a doctor. I'm not giving medical diagnosis. They need to make these decisions, at their own, based off their own situations and the best information they have. But just from a strictly tax purposes, if this is something that they can do lumped into 1 year, definitely going to help maximize their total expenses. And I want to go ahead and open this up to the second polling question. And this is a polling question we did last time with the Schedule A deduction. So if you've seen this once before, you may remember the answer. But can you deduct a weight loss program as a medical expense deduction? And try to go and actually think back to some of the qualifications earlier and think, is this going to be something that's going to be allowed? So we'll give you all about 45 seconds to a minute here, then we'll go ahead and explain the answer.
All right, I'm closing it now. So we've got, again, another split, 53% saying yes and 48 saying no.
Oh, fantastic. I'm asking very good questions then today. I'm very happy with the split here. And I'll be honest, this is a bit of a trick question. It's really not a standard yes or no. And the reason I included it is just so we can talk about some of those items that are qualifications that we always need to be thinking about. And the reason, I guess the short answer is yes, given a certain qualification. And this is preventative care, right? That we want to make sure that we are staying healthy and we're not going into long-term problems. So it does check that box. However, when it comes specifically to weight loss programs, it's only going to be deductible if a doctor has diagnosed them with the reason that they need to get on a weight loss program. So, like all things in the tax code, while there may be those broad definitions of what a qualification is and the boxes it has to hit, it is almost certainly there's always exceptions to every rule. There may be a little bit more specific items that you have to look into, determine if you can take these deductions. So really, whether you answered yes or you answered no, you could be right, you could be wrong. So just be aware that it can be very difficult to remember all of these things. We're going to look at something called the tax book here in a little bit, which can really quickly get you this sort of information instead of having to sit around on Google and trying to figure this out for yourself. And getting back into the lump sum medical expenses, I have two examples here. And these examples, you can see example one and example two, they both have an AGI of $100,000 for both years. And if we look at example one, we can see, okay, they had medical expenses for both years of $10,000 even. And if we look at 2022 and 2023, well, we have to hit that 7.5% cap. So let me go ahead and bring up my calculator, and we can just briefly do the math of how I calculated this. But we have $100,000 for our AGI. The first 7.5% not going to be deductible. So let me go ahead and redo that. $100,000, 0.075. There we go. So that first $7,500 not deductible. So we're going to take a $2,500 deduction in both years. However, and if we look at example 2, if we have an AGI, same of $100,000, but we split up the medical expenses between $15,000 and $5,000, that first year, we're going to take the $15,000, subtract the 7.5% AGI, we're getting a $7,500 deduction. And then it looks like for 2023, I made an error here. That should not say $5,000. That should say $0 because they are not going to hit this 7.5% cap. But when you take the total of 2,500 both years, we'll just multiply that by 2, they're getting a total deduction of $5,000. Whereas just for 2022, even though the medical expenses were the same, they are getting the 7,500. And just to be clear, that is an error. That should say $0 for 2023. So that was kind of what I was talking about, trying to lump in the medical expenses in a given year if it is possible, and it's not going to put them at, a health risk. Moving forward from medical expenses, I want to talk about state and local tax deductions. Typically, not always, but if someone has the money to afford someone to do their taxes for them, most of the time, not all the time, but most of the time, they're going to be able to afford a home and a residence and a car. And the IRS is going to lump these 3 deductions into 3 categories: income taxes, property taxes, and sales taxes. I would say in my time as a preparer, property taxes were by far the biggest one that I would deduct, just based off the amount that would, typically just from the home itself. That's usually, a multi-$1,000 expense that most people are going to have. But, don't forget about some of the smaller items. A lot of states require property taxes on things like cars and boats and things of that nature. And the main thing that I would recommend that you look out for is that this deduction is capped at $10,000, and that deduction is not split up between income taxes, property taxes, and sales taxes. You cannot take a $10,000 deduction for each one of these income or tax categories. You're going to have to take $10,000 total for all 3 of these combined. One more item I want to go through before we actually jump into the tax preparation software and start playing around with some figures is going to be the mortgage interest deduction. And just like with medical expenses and just like with our state taxes, there are going to be certain qualifications that need to be hit. And recently, this has changed. It used to be it couldn't be more than a loan of $1 million. Recently has changed to $750,000. Now, some people have been grandfathered in to that $1 million limit, but for anything new that has been purchased recently, going to be the $750,000 limit on what their loan is. Maybe not necessarily the total value of the house, but the amount that they are borrowing from the bank in order to actually purchase this house. And this is going to be stated on a 1098 mortgage interest statement. If you have been preparing taxes, this is really one of the more common forms that you're going to run into. On my next slide, we are going to go ahead and actually go and take a look at what this is and where we actually report the income. And then lastly, there are going to be some certain limitations, like most things in the tax code. Only the interest on your primary or secondary home is deductible, and that loan must be specifically used to either purchase, build, or improve the residence. And I think the key word there out of those 3 items, purchase, build, and improve, is going to be improve. I don't think a lot of people know that even if you take out a loan to do some capital improvements, you need new flooring, you need a new roof. These are still items that can be deducted even if they aren't typically or aren't necessarily used to purchase or build the house. And then we are not going to get into this today, but certain business related loans can also be deducted. If maybe they own the building that they actually run a business out of. Not going to get into this, but just want to make you aware that, there's always these items within the tax code where it doesn't really even seem like it should belong with what we're talking about, but there are these exceptions that they go ahead and add in. So let's go ahead and go to the next slide here. And this is what a 1098 is going to look like. I actually just went off Google and picked up a generic one. You can see this one is from 2015, so it's aged quite a bit, but luckily the tax forms that we work with, the tax worksheets, they don't really change that much as we go forward. So I just want to make you aware of this. And let's actually go ahead now and jump into TaxWise, which is going to be our tax preparation software that we're using today in order to go through and actually show off the Schedule A. And it looks like I was logged in, I was logged out. So I'm going to go ahead, open up a new browser here, new tab here, and I actually have my version of TaxWise saved. Go ahead, put in my client ID. No, I'm not a robot. And we're going to go ahead and click log in. And I actually have two returns that I want to show off today. We're going to start off with John Smith here. We'll open up his tax return. And John Smith is mostly a blank return. I believe I have a little bit of W-2 income entered in here just so, yeah, $65,000, just so we have something to actually deduct from. And he's currently getting a refund of about $5,000. But what we're going to do is, do we have a Schedule A? We do not. So I'm going to come to this Add a Form button. We're going to go type in Schedule A. We're going to go and add this worksheet into our tax return. And you can see that the order that I went through some of these items while giving the broad concepts of what is deductible, I actually just went on the Schedule A and kept the order exactly the same. You can see we have our medical, dental, our taxes paid, interest paid. You can see I just took the form and that's the order that we're going in. So we're going to start off with our medical and dental expenses. And we can see that the tax software is actually calculating some of these key limitations for us. We can see, okay, the $65,000, well, that's just pulling from our AGI line on the 1040 itself. And we have the 7.5% deduction cap that must be hit before we can actually deduct anything. And we're going to have two ways to go and really enter in these different medical expenses. We just want to take the broad macro number. We could, just go ahead and type in, oh, they had $4,000. We tab over. We can see line 4 didn't change. And the reason line 4 didn't change is $4,000 is going to be below that 7.5% cap. So even though they accrued and paid $4,000 in expenses, none of it is deductible. It really is giving them no tax benefit whatsoever. And when you see this situation, this should really be the first bell going off in your head. It's looking like, just starting off here, the standard deduction probably going to be better. It'll be dependent on what we enter in down below. But that would be my first bell going off. That is this even going to be worth it? Also, I should know, we're going to go ahead and re-zero this out. We have a way to go ahead and enter in more detailed line items into this one specific line. And how we're going to get there is this little tiny arrow, which you can probably just see, that's pointing to the right. Well, if I click on that, there's a way to actually link this to another form, and nothing's existing, so we'll click new. We can actually go to a detailed Schedule A that's really going to go ahead and drill down into these specific numbers. So I'm going to go ahead and bring up the Schedule A here. And it's going to focus on the medical portion of this to start. And we're going to go ahead and just enter in all of these items, other medical expenses. I think this is probably the most common place to enter in, the everyday expenses that people are having, things like doctor visits. We'll go ahead and say they had $2,000 in doctor's visits. Dental and vision. We'll say they had $1,500. Another common one is definitely going to be prescriptions. We'll say they had a lot of prescription costs. We'll say they had $5,000. And you can go on down the list. We could actually add in one more, ER visit. We'll say that was rather expensive at $4,000. And as you go and you start to type in these numbers, it's actually going to total them up automatically for you. But before we go and jump back into the Schedule A to see this total, I do want to talk about a very overlooked deduction that you can actually claim that most people definitely do not track, nor do they claim. And if we scroll back up, we can see we have medical miles. And this is actually broken up between the first half of the year. We can see we have 1/1/22 to 6/30/22, and then we have the second half of the year from July 1st to the end of the year. And we can see these are actually pinged at different rates. The IRS did not give us a standard rate for the medical miles. And you could go ahead and say, okay, well, while I was driving to all those doctors and dental care, I actually drove a total of 250 miles, and my spouse drove 100 miles. And look, we're starting to see this automatic calculation come through. And I'll be the first to admit, they're probably not going to get rich based off of the miles that they drove. But Sometimes people do have to go travel far distances for medical care, especially if they're in a rural area. And when you get into a situation like that, maybe someone had to travel back and forth uh, every day for care. And I can actually give you an example of that. My mom had to get a few years back, she had a total body infection, and they had to go and inject her with antibacterial, I don't even know the exact words, disinfectant, in order to, clear her system of the infection that was occurring. And she had to drive 50 miles back and forth each day for 6 weeks, and she accrued a ton of medical miles. And for that example, if you have to go 50 miles each day, it's 100 miles times 7 days a week, and then times the 6 weeks. She put on 4,200 miles. And then we can see there, well, now we're looking at $924. That's not, still a huge deduction, but much higher than, your typical run of the mill. And what you're going to run into is most of your clients just going to doctor's visits, going to the dentist. They're not going to track this. You could tell them about it. They may think you're great for knowing about this little extra deduction, and maybe you'll get a few people to do it, but the vast majority just aren't going to keep a mileage log for just the run-of-the-mill doctor's visits that you incur every year. However, if you do know that any of your clients are going through a major thing and they are constantly traveling back and forth, recommend that they go ahead and recreate that, even if it's after the fact. So if they did something every day for X amount of days, and the miles, get that information from them, as it can help really drive down that deduction. And you're really doing your due diligence to make sure your clients are getting the best possible deduction possible. And now that we've entered in some of this information here, let's actually go back. We can see the total, 13,487. Let's actually go back into our Schedule A. We can see that this 13,487 has pulled from where we entered it on the detailed version. And this actually is going to surpass our cap. And look, this is an $8,600 deduction. That's pretty hefty for just medical expenses. And if we were to go back into our PowerPoint here and scroll back up to the standard deduction, well, we can see that we currently have not hit what the standard deduction would be, but very likely they're going to have some expenses here in the future that may get them over these thresholds. So jumping back into TaxWise, let's go ahead and focus now on the taxes that you paid. And you can see that this is going to be broken up into various categories, right? We have income taxes, general sales taxes, which we talked about a little bit earlier on the slide, state and local real estate tax forms, going to be located right here as well. Personal property, think of cars and things of that nature. And then we kind of have a catch-all here for any personal property that they may have incurred, but maybe there wasn't a specific place to list it up above. Definitely going to have a place to go ahead and enter that. But let's go ahead and enter in some of these state and local real estate taxes. So we're going to go ahead. I'm going to go to this section here for the real estate taxes for the primary residence. We're going to link back to a scratch pad, and we're just going to say primary residence, real estate taxes. We're going to say they had a very nice home. They had $15,000. Actually, let's actually go back and see what the real estate taxes were on our sample 1098. So let me go back into the slide. You can see line 1, which I have circled, that's the mortgage interest. But we also have the real estate taxes listed down below here, and it looks like it's $87.66 once we round up. So let's actually go ahead and put that into our tax prep software of $87.66. Not going to add in anything else, but you potentially could. If they did have a second residence, not their third residence, but if they had a second residence, you could obviously add it right here on this line. We're going to go back into the Schedule A. We can see this is starting to flow through, and their tax deduction is really starting to grow. Going to go ahead and go and enter in some more property taxes. And, I have the option always to link it back to the worksheet, but sometimes you may find it's not necessary. Maybe there's not enough to really justify it having its own worksheet. I'm just going to say they had a few cars. We got the numbers in, and they went and paid $1,800 in taxes for those cars. And we can see the amount is now over $10,000. But when you think back to some of the limitations and caps that we have, software is automatically capping it at $10,000. And that's back to what I was saying, where even if you have a ton of taxes in all of these different categories, the grand total is going to be capped at $10,000, which we have reached. So they're getting the full $10,000 deduction for their various state and local taxes. Continuing to move down the Schedule A, let's go ahead and look at the interest you paid. And you can see that there's a few separate sections for this. We have the home interest and points. You didn't use all of your home interest and points to buy, build, or improve your home. Check this box, and that really is getting back to our 3 categories that we can actually go and deduct these loans for. If we were to check this box, it's going to go ahead and prompt us to go ahead and actually divvy up, okay, what was used to buy, build, and improve, and what was used for other miscellaneous items that aren't deducted. Not going to get into that today, because I think once you know just the 3 separate categories, it is pretty easy to go ahead and know exactly what will and will not be deducted. And I'm actually going to come to the bottom here of box A, and Form 1098, not listed above. Well, we have our 1098, in our PowerPoint, and we're actually going to go ahead and link one more time to the worksheets. We're going to link to another scratch pad, and we're going to say mortgage interest for the primary home. You can see it'll even let you know, like TaxWise is so good, it'll even let you know if you miss a G while spelling mortgage interest. And we're going to go ahead and say they're worth $13,000 in mortgage interest. We'll tab over. We'll go back to our Schedule A. And can you see what's happening on the left-hand side here? Even we have our home Schedule A right here, the main form, but everything that we're adding underneath of it is, being populated right underneath of the Schedule A, where if we ever need to see, okay, what exactly is pulling? Well, we can see the taxes we just entered. We can see the mortgage interest we entered, and then we have our Schedule A detail for the medical expenses as well, listed right here. And as we scroll down, we're starting to get a huge Schedule A deduction. Look, we're up to $31,000. We go back into our PowerPoint. We can see we're basically above any threshold with these basic standard deductions for, these separate categories right here. So this was a scenario where definitely taking the Schedule A has helped us. Now, want to go over a few more items that are listed here, and want to go talk about gifts. And one of the things with these green underlines within TaxWise, this is letting us know these are calculated fields. If I try to just enter in the numbers and saying this is a calculated entry, you got to jump to the specific worksheet. So I'm going to link one more time. We're going to do existing, because this is actually going to be on our detailed itemized worksheet. We're going to scroll down, and we can see a few different items. We can see cash contributions. 60% is going to be the deduction rate. So we could go ahead and say we gave some money to United Way, and we'll put that at $1,000. And then if we scroll down a little bit further here, we can see we have our other than cash contributions, kind of an awkward way of just saying, material things that you donated. We could go and say, we went to Goodwill, we donated 700, oops, that is also a calculated field. Let me go and, it's gonna pull from above here. We can go and say, okay, we went to Goodwill, we had $1,000 from there. And, these are going to be taxed at deducted at 2 different rates. You really don't need to know as much, though, just because, you're going to have your separate areas within the software. And then lastly, you can also do charitable miles. Just like the medical miles, this is kind of a not very well-known deduction that you can go ahead and take. And this is actually even at a lower rate than the medical miles. I would say, unless you're doing taxes for a socialite that is constantly doing charitable functions all over, her regional area where they're driving constantly, they're probably not going to track this. They're probably not going to get too much of a tax benefit just driving through to the United Way or Goodwill or, wherever. But, let's just say hypothetically, we did have someone they were doing a ton of charitable work and constantly on the road. Say there were 500 miles, $70 deduction. I guess every little bit counts. I don't think it's going to make too much of a big deal. Based off of what their total itemized can be, but just a nice little trick where maybe you'll have this specific client, here or there, but this will really help them out. So, the main points that I'm trying to make is there are a lot of different key categories that can be deducted given our certain limitations, and it's all really on the Schedule A. And if you have any specific areas that you need to go into detail, just always link to the worksheets. That's where you're going to actually be able to put in the detail and keep your Schedule A looking nice and clean, but having everything itemized out with a list so you know exactly what is going into each one of these fields. Now, it looks like we're about at 12:42 my time, and we will be ending at the top of the hour. So there are a few other items that I do want to talk about before we go ahead and open this up to a Q&A session. So let me jump back into my PowerPoint, I believe for the final time here. And let's go back. We were looking at the 1098. I want to talk about above the line versus below the line tax deductions. And you can't really get a solid answer on what's better. And a lot of the times you can't really pick and choose which one you're going to deduct for your client. But the general breakdown of what it means to be above the line or below the line, it has to do with AGI. And why above the line I think is better is that it actually lowers your AGI, which can make hitting some of these other items a little bit easier to hit. So if you have things like retirement income, student loans, even Schedule C expenses, which I know is a little bit out of our scope, I just wanted to put it on there just to give you a broad, comprehensive view of above the line deductions. This is actually going to reduce their adjusted gross income. And think about our previous example when we were talking about medical expenses. Well, they had $100,000 in AGI, and there's a 7.5% cap. So, I did it twice live here. Go ahead and do this one more time. There we go. So we're having to hit this $7,500. What happens if they had some student loans, some hefty student loans? Well, that would actually reduce their AGI. Let's just say, for example, they paid off $20,000 in student loans this year. Well, that's going to put their total AGI at $80,000. Since we can reduce it, we need to hit the medical expenses. Look, it's gone down from $7,500 to a $6,000 cap that we have to hit in order for those expenses to be deducted. And if we look at some of the below the line items, these are not going to reduce your AGI, but these are going to be items that are still going to reduce the tax return. And these are the three items that we looked at today: the unreimbursed medical expenses, the state and local taxes, and the mortgage interest. Most items located on the Schedule A going to be those below the line deductions, but always be on the hunt and make sure that you are getting all of the above the line, as there's a trickle down effect that can help some of these items in particular when it comes to medical expenses. And it actually used to get the name above the line versus below the line on how it was listed on the tax form. Above the line deductions would always be above a certain place where AGI was calculated. Below the line would always be below. That's how it used to be set up. I think it's a little bit different now. One more thing to go over is I do want to talk about when to force this, the itemized deduction to the state. And let me jump into TaxWise here for the last time. We're actually going to go into a different return that I've kind of pre-set up to show this. We're going to Ben Logan's return here. I'm going to go open this up, and we're going to jump. Yes, let's see. So we're set up right now with the standard deduction. And within this tax return, let's actually go to the 1040. You can see that I have some wages here. I think that's the only income that I have. But if we actually jump into the Schedule A, you can see I went ahead, put in some medical expenses, did some state and local taxes, and then finished it off with some property taxes here as well. If we scroll down, after the charitable contributions, we can see there's a roughly $21,000 deduction. Now, if we scroll up, there's a place within TaxWise where you can calculate what your refund is going to get. And I can say for this return, right now we're looking at the standard deduction. And when you look at the federal and you look at the state, let's go ahead and add these up. Let me bring my calculator back here. All right, so we have 516 for the federal plus 394 for the state. Now, this is with the standard deduction, and Georgia is going to be one of those states that requires if you take the standard on the federal, you take the standard on the state. If you take the itemized for the federal, you take the itemized for the state. Now there's a place, so we're at 910, there's a place, let me go back here. Within TaxWise, we're gonna go back to the 1040. We're gonna scroll down, scroll down, scroll down. Standard deduction or itemized deduction. And you can choose to override the standard deduction. And typically it's going to take what is best for the federal return. However, this is just a box that you have to click and it's going to automatically change it to the itemized. If we click this box, we can see the deductions have changed. And they actually went to a refund of $516 on their federal to owing $36 total. But if we look at Georgia, look what happened with Georgia. It's actually at a $1,208 refund. And if we go back, we can see, okay, they were getting a $910 refund from the government. Let's go ahead and add in these numbers one more time. We're gonna go ahead and take the 36, we'll make that a negative. And we're gonna add in the state of 1208. It's an $1,172 deduction, which I believe, what was our other one? 908. You saved them $264. And if we get back to my example of talking with my friend this past weekend about his taxes, I think he would have been happy with an extra $264. You know, I don't think it's going to change anyone's life greatly, but you know, this is just one of those little tips and tricks that we can use to really go and add value. And why it's so nice, so all I had to do to really figure out, okay, which one's gonna be better, is I checked a box. It was a single click of the mouse. You can add it up real quickly what the total refund is. And then, you know, if you go and you have that post-tax meeting with your clients, you're gonna be able to say, hey, I found this little trick where we actually itemize both, and you're gonna owe a little bit of money on the federal return, but your state refund is going to be so great that it's actually going to give you an extra $250, $300. There may be certain examples where that amount grows. And if you do that, I guarantee your clients are really going to feel like you're putting in that extra effort to go and, you know, get that refund as big as you possibly can. You know, this is kind of a niche situation. I won't lie to you. I don't think you're going to have to do this very often, but just given the ease of how easy it is to do, just click the button, run the math real quick, and then you can go from there. So with all that being said, that's really going to get me through the items that I wanted to talk about in this presentation. I would like to open this up to one more polling question, then go over some dates that we're going to be at some specific conferences where you can actually meet the whole TaxWise team. And then if we have any time after that, we will go ahead. I'll try to do a few Q&As. I don't think there'll be a ton of time, but we'll get through as many as I can. And the last polling question is the polling question that we always end with. And this is, would you like a more in-depth product demo and further details about TaxWise Online? We have our three options, yes, no, or I'm already using TaxWise. And what we mean by a product demo, you know, this is a webinar here today. There are many people on this, and this is meant to help everybody out. We actually schedule one-on-one demonstrations with you where maybe you're thinking about getting into this profession. You're looking for a tax software. Maybe you're not very happy with your current tax software. We'll spend typically an hour, whether it be me or one of my colleagues. We'll go through every exact question that you have and show you how you would perform this within TaxWise. So you could make a very well-educated decision on if this is going to be something that works for you. So we want to go ahead, ask you if you would like for us to go ahead and reach out to you and possibly schedule one of those one-on-one demos to get you as comfortable with TaxWise as possible. So I'll give you all a little bit of time to go ahead and answer this, and then we will go ahead, go over some of the dates where you can meet me or some of the other people on the TaxWise team, and then we'll open it up to the Q&A.
I'll go ahead and close it now.
Sure.
Okay, cool.
Okay, are you ready for me to move forward to the forum dates?
Yeah, let's do that.
Okay, so there are quite a few events coming up that I will be going to, some of the other members on our team will be going to. And you can see this schedule right here. We're going to really a lot of different geographical locations in the United States. And if you would like to meet me, I will be going, I believe, to every one of these besides the New Orleans IRS tax forum. And the reason I won't be going to that one is because that overlaps with the Latino Tax Pro Conference in Vegas, which I will be a keynote speaker at. But any of the other items, places, Atlanta, DC, San Diego, some of those are very nice places to visit. I will be there. You can go ahead and meet me, and you can meet the other people on our team. And when it comes to the New Orleans trip, there will be representation from Wolters Kluwer that are very knowledgeable, very skilled. I believe the actual product manager of TaxWise is going to be there. So if you are using TaxWise or thinking about using TaxWise, you have any really specific nitty-gritty questions, he is the best person to ask. So would highly recommend that New Orleans trip as well. Are there any questions that arise that you could ask me, Amar?
Let's see. So there is one. Gifts to relatives are not an itemized deduction. Is that correct?
In my experience, gifts of cash, no, but there are gifts of property, which people have been used to itemize on their deductions. So it's kind of a loophole within the Schedule A and within the IRS code, where you can still claim that deduction, but a straight cash gift to a relative not going to be allowed to be deducted.
I think that's the only question we actually got today. Unless anyone has any last minute questions. Alicia says she loves the tax book, so that's great. Beyond that, there aren't really anything. There was a question about handouts. We don't actually have handouts, but you will get an email of the recording after this, as well as the presentation that Ryan shared. So you will have that in your email after this. But beyond that, unless anybody else has any questions, I think we may wrap up a little early today. Yeah, I don't see any trickling in. So thank you everybody for joining us, and thank you Ryan for your presentation. And we hope to see you guys again in a month.
Thank you, everybody. Look forward to meeting you all at these different forums if you can make it. Thank you very much.
Bye, all.